Welcome back. Today is day 11 Confluence. We are going to learn how to combine your technical analysis to provide clear market direction. So everything you have learned from day 5 with Japanese candlesticks, then on to day 7, understanding market direction, how the market moves. Day 8 with technical analysis, we learned about support and resistance and different chart structures. Then day 9 and 10 with harmonic patterns, we are going to learn how to combine all of your technical working tools into one incredible trading strategy. Now in today's module, it will be a 4-topic module, starting off with defining Confluence, followed by multiple time frame analysis, onto trading checklist, and we will finish off with step-by-step market analysis, where I will walk you through every single instance of a trade. So when we're actually on the charts, I'll show you exactly what I look for when looking at a trading setup. Now in yesterday's module, which was day 10, advanced harmonic patterns, I would say that was probably the most technical module in the entire 14-day course. You learned 3 very specific price patterns that occur in the market. You learned the Gartley, the butterfly, and the crab. Now we know that harmonic trading is an advanced methodology which measures specific price zones. And this is the base of our trading strategy, as it optimizes every instance of a trade. And that's why I think most trading strategies, that's where they go wrong. When people develop a trading strategy, they don't know what to do in every single instance of a trade. They can identify a setup. They don't know exactly when to enter. They maybe get the area correct, but we know exactly when to enter. Once it hits the D point, once that price level has been confirmed, we're looking to either buy or sell. We know how to manage a trade. We know exactly when to get in, when to get out. And that's something you will go over in day 12. You haven't learned everything about harmonic trading just yet, but you do understand the patterns. You understand the methodology and how it works. So you can now apply the bat, Gartley, butterfly, and crab. And you can also apply bullish and bearish variations. So you've learned 4 patterns. All of those have both bullish and bearish variations. Today we'll be piecing together everything you have learned so far. As mentioned, we will be piecing together everything from day 5 to day 10 into one incredible strategy. And that brings us on to our first module for today, defining Confluence. Now Confluence, it has many different meanings, but to us it is the combination of multiple strategies, ideas, or technical working tools into one complete strategy. As mentioned at the start of today's module, we will be combining Japanese candlesticks, market direction, such as a trending market, ranging market, everything you have learned into one strategy. And this is how you would simply define Confluence. When we look for confluent areas in the market, we are looking for a zone or an area, a general area where 2 or more levels or tools are intersecting. So they link up. If you think of, and this is actually the official definition, I'm pretty sure, don't quote me on that. But when you're defining Confluence, if you imagine 2 separate rivers, they're not connected, and then they intersect. They join together into one nice flowing river. So you've got 2 rivers side by side, not connected, and then they intersect, or they join together to create a larger river, of course, in the same direction. Now what Confluence does, it provides a clear view of market direction, and it helps us better understand future price movements, which of course benefits us in trading situations. If we can have a better view on where price is going, we can obviously have more profitable setups, more profitable trades. Simply speaking, Confluence provides additional confirmation. So instead of looking for just a buy on support or just a bat pattern, you'll look for several different working tools in the same area. And don't worry, I will go over this in more detail today once we go over step-by-step market analysis in our last topic for today. So as mentioned multiple times now, we will be combining everything to provide a framework for finding highly profitable trading setups, and that's what it's all about. So let's just have a technical recap. What have you learned so far? What can we combine to provide a clearer view on market direction? Of course, in day 5, we went over Japanese candlesticks. You learned the bullish, bearish, and neutral versions of candlesticks. You have your Maribozu, long day, hammer candles, shooting stars. You have your doji candlesticks. Of course, we went over double and triple formations for bullish and bearish as well. These are the kind of things you want to be looking for in the market. Again, use it to help you analyze future price direction. We learned about the different types of markets. We have a trending market, ranging market, and congested market. We also learned in day 8 about trend lines, support and resistance, the 3 price channels. You've got ascending channels, descending channels, and horizontal channels, which are similar to a ranging market. In day 8 part 2, we went over triangles, pennants, wedges, flags, and price gaps. And finally, you learned 4 harmonic patterns. And trust me, there is more to come, but right now, you have learned a lot when it comes to analyzing price charts. When it comes to analyzing an asset, you've got a lot of working tools that you can use to your advantage. And this is what we will be combining today into one incredible strategy. I'll show you how you can utilize everything that's on this screen to provide clear market direction, to provide high probability trading setups. And that's what we'll cover in the last topic of today. Now onto our second topic, which is multiple time frame analysis. And again, everything I'm going over in these topics, they all play a part and they all link together in the fourth topic of today. So the last topic, I will cover everything that you see from topic 1, 2, and 3. So multiple time frame analysis is when you consider price movements on other time frames that may affect your position. Now, as mentioned, way back in day 4, we went over your trading personality. We identified that we are swing traders. Now, some of you may be day traders, scalpers, position traders, but for the most part, swing traders. We are mainly swing traders. And we use a 1 hour time frame, a 4 hour time frame, and the daily time frame. Now, this is what we call multiple time frame analysis. We don't just use one time frame, we are using multiple time frames for analyzing assets. Now, being consistent in this approach will give you a clearer view on where price will go next. So again, this plays a part on future price direction. This helps us pick out high probability trading setups. Not only will it help you to become a more consistently profitable trader, but it will reduce losing positions as well. What you may see happening on the 1 hour time frame actually is entirely different when you look at the daily time frame. You may be looking to go short, but a reversal is happening on the daily time frame, and actually there's a new uptrend establishing. Therefore, it would have been a losing position. So these using multiple time frames can help you identify maybe mistakes, errors, or potential pitfalls ahead of time. And I've already explained this. I've obviously forgot this point was in here. As explained in day 4, you should operate on 3 time frames in alignment with your trading strategy. So as I've mentioned already, swing trading, we look at the 1 hour, the 4 hour, and the daily. Day trading, we look at possibly the 15 minute, the 30 minute, and the 1 hour, or even the 5 minute, the 30, and the 1 hour. For position traders, you're looking at the daily, weekly, and monthly. And a scalper, you're looking at possibly a 1 minute, 5 minute, and 15 minute chart. So here we go. You can write this down if you've not already got this. Swing traders, mainly 1 hour, 4 hour, and daily. Or we can use a 15 minute, 1 hour, and 4 hour. Now, to simplify this even further for you, we have our 3 time frames. And this is what I would call the minor, intermediate, and major time frames. Now, your minor time frame, this is a lower time frame than your intermediate, and it's typically 4 times less. So your intermediate time frame will start off here to make the other 2 easier to understand. Your intermediate time frame is where you will seek your trading setups. So let's say we use the 1 hour, the 4 hour, and the daily chart, and I find a bullish bat on the 4 hour chart. I would then use this as my intermediate time frame because this is where my trading setup is. Of course, harmonic trading, this is the base of our trading strategy. If you find a harmonic on the 4-hour chart, this is your intermediate time frame. So essentially all analysis found elsewhere will be based around this trading setup. Again, because harmonic patterns are the base of our trading strategy, this is where the intermediate time frame will be. Now the minor time frame, as mentioned, will be lower than the intermediate, typically 4 times less. So we have the 4-hour time frame for the intermediate time frame. That's where we found the bullish bat. So we can agree that the 1 hour is 4 times less. The 1 hour is 4 times less than the 4-hour chart. And this is used to scale down for entries and exits. Of course, you can see on the 1 hour chart, you have 24 candlesticks, whereas the 4, you have significantly less. So there is more activity. You can see what's going on. You can get into the pits. You can see exactly what's happening on the charts when you scale down. So your minor time frame is used to manage entries and exits. And this is to be able to capitalize on those aggressive reversals ahead of time. You may not catch these on your intermediate time frame. So the minor time frame, this is why it's essential. So again, just to recap very quickly, intermediate, this is where you find your base of your trading position. Your minor is where you enter the trade and exit the trade. And in your major time frame, this is a higher time frame than your intermediate, typically 4 times greater. Now we use the 4-hour and the daily, which of course is 6 times greater than the 4-hour chart. So this is used to analyze the bigger picture. We use the daily chart, analyze the overall sentiment of the market, the overall trend, and this helps us provide a clear view of market direction and see where your intermediate setup fits in. So does it make sense? Does your intermediate trading setup fit in with the bigger picture? And that's essentially what you're analyzing here. Now the minor time frame, intermediate time frame, and major time frame, this links in with all trading personalities. This doesn't just apply to swing trading. This is for scalpers, day traders, swing traders, and position traders. No matter who you are, what your trading personality is, this is how you should be trading. This is how it should look. You will have a minor time frame if you're, let's say, a day trader. It may be the 5-minute. Your intermediate time frame may be the 30-minute chart, and then your major time frame could be the 1 hour. Now, we could also use, as a swing trader, we could use the 1 hour as our intermediate time frame. We could use the 4 hour as our major time frame, and for the minor time frame, we could use a 15-minute chart. So again, when you identify a trading setup, this will be your intermediate time frame, and all you need to do is work out what's my major time frame and what's my minor time frame. And trust me, this will definitely help you be more thorough in your analysis. So just to round off this topic, the majority of new traders only focus on one time frame, and this is where a lot of them go wrong. And this is what I would call tunnel vision. They're just focused on the one thing. They get their trading set up and it's a solid buy or sell, and that's it. And that's why many people lose in the Forex market, the cryptocurrency market. They just lose non-stop, and it's simply because of silly, small mistakes like this. You want to be open in your approach to develop a feel for the market. This is something I've spoken about many times. You want to have a feel for the market, have a connection. You need to be in sync with the market, and this will help identify where you are in the bigger picture. The higher the time frame, the larger the impact. So that's why we have the minor, intermediate, and major time frames. The major time frame can help us identify where we are in the bigger picture. Does our intermediate setup align with the major time frame? And for example, when a trend has had more time to develop, the impact of the reversal will be significantly greater than one on a smaller time frame. So we can agree, if we have a harmonic pattern on the daily chart, a bearish bat for example, and we experience a reversal, a successful trade, we can agree that the impact of that trade alone will be greater than a bearish bat on the 1 minute chart. It will be extremely aggressive in comparison to the 1 minute chart. The move will maybe be 1,000 pips, whereas the 1 minute chart may be 10 pips. So again, the higher the time frame, the larger the impact. And that's why we have these 3 different time frames for using in our analysis. And this can be extremely powerful in harmonic trading. It provides insights that we may have missed by only using one time frame. If we only use the 1 hour, again, we will still find profitable trading setups. Whereas if we use several time frames in our approach, we can then find higher probability setups. It can also help limit risk, help reduce losing positions. You may see something on the daily chart that does not align with your position on the 4 hour. You may have a bearish bat in the 4 hour, and you see something on the daily, and it's indicating the total opposite of your trading position. And these are the kind of small indications that help you from losing trades. Just small changes. So multiple time frame analysis, this is something we'll talk about more in the last topic of today. But let's head on to our third topic, which is trading checklist. Now, every single position you take, whether this be in Forex, cryptocurrencies, commodities, stocks, whatever market it may be, use this checklist as a guide to help pick only the best trading opportunities the market has to offer. And that's what it's all about. This is the most important part. You want to have a defined checklist. And when we go into day 13, we will cover a trading plan. But this checklist is just something, a small guide, so to speak, something to go by when you're looking at the charts. So first of all, we ask, is there a valid harmonic pattern? Is there a harmonic pattern on this chart? Is there an M or W type structure forming on the chart? Because this is the base of our trading strategy. And let's say, yes, there is. It's on the 4 hour chart. This is our intermediate time frame. What pattern is it? Well, we've identified it as a bat pattern. It's a bearish bat. Number 3, where does the pattern complete? So where does your PRZ form? Where does your D point complete? If it's Great Britain pound, Japanese yen, where is the D point? Where would you buy in this situation? Number 4, are there further indications of a reversal at the PRZ? So what aligns with your potential reversal zone? Is there trend lines? Is there support and resistance that aligns with your potential reversal zone? Is there maybe a pennant in the C to D leg? What indications are there that the reversal will occur? Is there any strong confluence that you can use to further indicate where price is going to reverse? Have you looked at the minor time frame? Have you looked at the major time frame? Number 5, what is the current market direction? Are we in a trending market, a ranging market, or congested market? What about on the minor time frame and the major time frame? Are they trending? What is the overall sentiment of the market? Number 6, are there any warning signs? So as I spoke about before, when you find your setup on the intermediate time frame, are there warning signs in the daily chart? Is your bearish bat or bullish bat, whatever the setup may be, indicating a sell, but when you go into the daily chart, it's indicating a buying situation? Is the pattern valid? Are the ratios correct? What about the structure of the pattern? How does it appear? How many candlesticks are in the harmonic pattern? Is there 100 candlesticks in the formation, or is there 10 candlesticks? If there's only 10, then maybe you want to look at a lower time frame, or maybe you want to look at a different trading setup. And number 7, do other technicals support the pattern? So this applies to your minor time frame, your intermediate, and the major. What else supports your trading setup? Is there a reason for a reversal to happen at the potential reversal zone? Now, as you progress as a trader, this checklist will definitely change, I can guarantee that. And this will be specific to the individual. You may want to add in parts where you look for something that I don't. You may use an indicator that I don't, and you can add this into your trading checklist. However, this is just simply put in place to understand the basics of Confluence. So again, just start using this checklist. It will change as we progress as traders. Definitely when you get to the Harmonic Mastery course, it will change entirely. But this is just to put in the working steps. This is what you simply want to look for when analyzing different assets. Now on to our final topic for today, step-by-step market analysis. This is where I piece together everything you have learned, everything from day 5 to day 10, and the last 3 topics we have went over in day 11. So let's head over to TradingView. We'll go over a few market situations. We'll go over minor, intermediate, and major time frames, and we'll go over the base of our trading strategy, harmonic patterns. We're now on TradingView. We're looking at Euro US dollar on the 1 hour chart. This is going to be our intermediate time frame for today. This is where we have our M-type structure. We actually have 2 different formations on this chart, so there's a very important lesson in today's module while we go over market confluence. Our minor time frame will be the 15-minute chart, which is 4 times less than the 1 hour. And our major time frame will be the 4 hour chart, which is 4 times greater. And we really want to stick to that rule when we're identifying our minor and major time frames, because what we don't want is a 1 hour intermediate time frame with a 30-minute minor time frame, and then we're looking at a 2 hour major time frame, and it just doesn't provide a wide enough scope on what's really going on in the market. We want to stick to that 4 times less for the minor time frame and 4 times greater for the major time frame to provide us with a wider view on what's really going on in the market. We can jump down to the 15-minute chart to get the finer details, to get a really precise entry in this potential reversal zone. So just keep that in mind when you're selecting which time frames to look at in your trading, whether you're a day trader, a swing trader, or even a position trader. Just try and utilize that 4 times less or 4 times greater rule. There's actually going to be 2 setups we're looking at today. The first one is, of course, Euro US dollar, which is a currency pair. And the second one is actually to give you a bit of perspective. We're looking at a cryptocurrency pair with Made Safe Bitcoin. And this is really to show you the true power of harmonic trading, that it does work in all financial markets and it works in all time frames. And throughout day 9 and day 10, we use different time frames to illustrate that fact. But we've not used different financial markets. We've not used different assets. And this is something I do more often in the Harmonic Mastery course with maybe futures, commodities, cryptocurrencies, because the 14-day course is Forex based. But just for the purpose of today's module, I felt like I want to give you some variation. So our second pair we're going to be looking at today is actually a cryptocurrency pair. Now, looking at the setup in front of us just now, we can already see the distinct M-type structure. And the first part in our trading checklist is there a harmonic pattern? And there's actually 2, like I mentioned before. We want to grab our XABCD pattern tool. This saves a lot of time when we're measuring moves. And this is also an issue with many traders when you're selecting which point to measure from. Should it be this low or this low? This low for maybe this M-type structure. And typically I always go with the lowest point where the move started. And this would still be a valid structure going with this XA leg. And this isn't the formation you want to go with, and I'm going to illustrate why in just a moment once we measure the move. And it is in fact the Gartley pattern. We're looking at a 0.786 to define that D point completion. And we can see that's exactly what we've got there. We had extreme price action going into potential reversal zone. A few Marubozu or long day candlesticks. Very aggressive price action. No signals of a reversal in that area. And what we really want to use when we're drawing up these moves is we're looking for a key level of support or resistance to confirm that potential reversal zone. I always go with, if I've got 2 patterns or maybe even 3 on the one chart, I always go with the pattern where it has the strongest level of support or resistance at D. And that really helps me select the best overall structure to go with and the best structure to trade. And I really stand by that. Now I'm just going to measure the move. This is a Gartley, of course. We're going from X to A. We're looking at a 0.618 B point. And like I've mentioned many times in the previous modules, we're looking to be as close to that ratio as possible. We can see price confirmed that ratio. This is in fact lower, so we're going to use the lowest point. We're always going with the lowest point in that area. Of course, this is slightly higher. See, price test the 618, barely goes below, maybe 1 pip below. We have a move up, followed by a retest of that 618, and that's what defines the B point. And we can see the overall structure of this pattern, very symmetrical. We can see the XAB, the left hand side of the pattern, completes within a similar time period as the BCD within this side of the pattern, the right hand side. And this is something we go over at a later point. For now, we're just looking at this M-type structure. We're becoming comfortable with the ratios. We want to be exact in our measurements. In this B-point flexibility, or this flexible framework that I've been talking about, we will define the extent in which this B-point could move. But when you're identifying these trading situations, you want it to be as close to that ratio as possible. And just keep that in mind when we're looking at the bat pattern, the Gartley, butterfly and crab. You don't want it to far exceed those ratios for now. You want to keep them within a close area. And what you don't want is price at 0.726 and you're still trying to declare it a Gartley, because it's definitely not. You want it to be within a close area of that 0.618 measurement. Now the C point, it's interesting in this situation, and this is something I've spoke about before with the 0.886 for the C point. And this goes for all harmonic patterns when we're looking at the C point of a 0.886 maximum. We don't want it to go too far beyond that. And I've said that in several patterns. It is the maximum measured level, but we don't want to go too far beyond that. It needs to be less than A. And there's many traders that use harmonic patterns or advanced patterns, and they'll allow their C point to hit almost equal to A, as long as the wick doesn't exceed. Now when I'm drawing up harmonic patterns, I prefer the C point to be closer to 0.886 than the ratio of 1. So of course 1 would be 100%, which would be A in every single pattern. You're always measuring from A to B. And this would mark the midway point. Around about this area here, we can always do it by eye. We can see that it's around about halfway between 0.886 and 1. And we really want C to be below this line. We want to be closer to 0.886 than 1. And we don't want it to far exceed that area. We don't want the C point to be away up here. I typically find that the best types of structures, they are within a close area of their measured levels. So we do want it to be as close to this 0.886 as possible. And because it's closer to this ratio, this 0.886, the maximum measured level, than it is 100%, the ratio of 1.0, it's a valid C point. And I'm just trying to keep this as simple as possible. We're not talking about the additional measurement that will be defined at a later point. I spoke about that many times in day 9 and day 10. But all we're focusing on just now is this M-type structure. We're then looking at the BC projection. This complements the 0.786. This defines the D point. We're looking at a 1.272. And in our final measurement, we're going from X to A. And this gives us a 0.786. So we can see we've got these two ratios converging in a very close area, almost exactly the same price level. And although we have that, we have extreme price action going into the potential reversal zone, price keeps pushing lower and we don't really see any signs of a reversal. The sellers are totally in control in this situation. We don't see anything that makes us want to jump the gun on this trade and get in as soon as price confirms these ratios. And that would have been the terminal price bar. And remember, this confirms the last ratio in the potential reversal zone. It would have been in this area here. And the last ratio was the 0.786. So what would the pattern be that we take? And if I just define this, it's got a good support. We can see it's got multiple tests. And the pattern that actually did end up completing, we did take, this is a trade from back in the early stages of 2018. We're actually looking at a bat pattern. We're looking at the same B point, the same C point, but the completion, you can see it almost confirmed it to the pip. And this is another good support level. And once we look at all three time frames, it will then become clear why the bat pattern was the formation to go with rather than the Gartley. In this situation, and if I just highlight the Gartley in a different colour, and I'll keep both of these on the charts. So we've got the Gartley in blue, I've got the bat pattern in black. The bat pattern, it meets the minimum 1.618 for the D or the BC projection for the D point. We've also got the 0.886. For the B point, we really don't want it to exceed 0.55. We want it to be lower than that. Like I said before, we want it to be as close to these ratios as possible. If I just highlight the B point in the bat, we're not looking at this blue pattern just now. You can see it's still within a close area. And if I just add in the 618, you can see price is closer to the 0.5 than it is the 618. And that's really what we want. We don't want price to go any further than 0.55. We're looking at a 5% maximum in the bat when we're looking at the B point. We don't want price to push far beyond 0.55. So we're almost at that limit. So it is a valid pattern. The C point, I've already explained the situation with the C point. It has exceeded the 0.886. We want it to be as close to that ratio as possible. And that's really what we're looking at when we're measuring these levels. They do have a certain degree of flexibility. You're looking for them to be within a close area. And you're probably sick of me saying that by now, but it's all about repetition. I'm making sure you guys understand exactly what I'm talking about. Now the BC projection, this is for the bat pattern, we're looking at the black pattern here. 1.618. That's the minimum level we're looking to confirm. And we can see how closely that confirms with the 0.886. So we've confirmed this ratio in the potential reversal zone and the 0.886. Although we don't have the second measurement or the alternate measurement in this pattern. This is the only measurement we're missing. It is slightly more confusing. And this is why we don't introduce this until the Harmonic Mastery course. For now, we're just focusing on these ratio alignments. And the 1.618, it forms just above 0.886, which is a good confirmation within a close area. And of course, this would be our terminal price bar, would be this candlestick here. It confirmed the 0.886. If you guys can see that. This would be the candlestick we're focusing on. We always wait in the candlestick to close. We don't enter as soon as it confirms the ratios. We wait in closing, and then we look to enter the move. So number one in the trading checklist, I've dragged it out quite a bit, but number one is there a harmonic pattern? And yes, we actually have two. I've identified two valid harmonic patterns. We of course know that the bat pattern is the formation that was successful. The Gartley would have failed depending on where your stop loss was. It probably would have been a failed formation. It would have hit your stop loss and then went into profit. And number two in the checklist, we've already skipped that part, but number two is, what pattern is it? And we've already identified that. We've got a Gartley and a bat. And we just need to identify which trading opportunity do we take. Let's assume that all of this hasn't happened. So if all of this hadn't happened, we would have identified these two trading situations around about this area here. We then need to determine which trading opportunity do we take. And number three, we also identify where does the pattern complete. So we need to draw in the ratios for the potential reversal zone. We want to be exact in our trading. We want to identify where all of the ratios complete within the potential reversal zone, because that's what the potential reversal zone really is. It's a convergence of ratios within a close proximity, within a close area. And we've identified the two price levels that we're looking at within these areas here. And then number four, we're looking at, are there further indications of a reversal at the potential reversal zone? We've got two very good areas of support here. The Gartley, multiple tests of support. It's almost created a trading range within this area here, within the two D points. The same with the bat pattern. It's got a good support for the D point, although we did have a drop below. We've seen the exact same with the Gartley support, except price pushed above. So we've got two good areas of support. Right now, it could be either one you could go with. And that's why we use the major and minor time frame. So let's look at the 4 hour and start to really identify which reversal area is best, where we want to really execute the position. And straight away, I can see a support trend line here, and I'll just ensure it's valid first. And what I'm going to do is take away a lot of this price action that's happened here, just to clear it up, so we're only focusing on this trading opportunity. Drawing the support trend line. You can see we've got multiple tests of that support trend line, especially in this area here. At least a handful of tests in this area. And this is where price confirmed the support trend line and we got the reversal. We also want to look at the overall trend of the market. And we can definitely see the market is uptrending on the 4-hour chart. And this is why we use the major time frame as well. But just quickly highlight the lows and highs in the market. We've got the low here, which starts off the move. And this would have been the high that I would have selected for this situation. Followed by higher low. We're then looking for a higher high. And it would have been this area here. Higher low, and this is where we confirmed the support trend line. We could have used this area here as a higher high. Ideally, we're probably looking at this area for the A point. We'll add this in. We'll add this in as a high and low. I wouldn't consider those a significant high and low in the market. That's really what we're looking at. And if I just remove these two here, got low, high, higher low, higher high, higher low at the support trend line, higher high, and this confirms our A point of the Gartley and the bat. And then this is where we're looking at the higher low at the support trend line. So this support trend line, looking at the major time frame, it provides more information on the potential trading opportunity that lies ahead. If we look at that candlestick that goes into the potential reversal zone on the Gartley, which is the blue pattern, and if I just bring that to the front, just for a moment so you guys can see this. It's got a very good support on the 1-hour chart. And I'd say it also does in the 4-hour as well. But the ideal completion, the ideal entry point is at the support trend line. There's more going for this bat pattern than there is a Gartley. There's not much aligning with that. A good support. The bat pattern also has a good support, but it aligns with the overall trend. We're looking to make a higher low in the market. And if I just measure from low to high with the Fibonacci retracement tool, and this wasn't pre-planned, I just want to see where this completes. We can also see that the D point of the bat pattern, it forms at 50% of low to high. So we've got our previous low in the market. This would be our higher low. We're going from our previous low to our high here, our higher high. And we can see the D point forms at a 50% retracement, which is another good confirmation for the potential reversal zone of the bullish bat. And we can see overall just the structure of the bat. That's really what we're looking at. We want to go with what is logical. We don't want to try and force our formations on the market. As I've mentioned before, we want to look for these distinct M and W type structures. We want to look for market confluence. We want to look for areas of reaction. And that's exactly what we got here. We can see if I just click play, this will resume the move. And if I just speed this up, the move would have completed around about this area here. And remember, this is based on the 1-hour chart. This is the major time frame we're looking at. We would have been out of the move around about this area here. Once we got this another impulse to the upside, we would have closed the position in a profit. And it really is just a fantastic trading opportunity. And we can see when we're looking at price moving back down towards the trend line, this would have been our warning sign. And when we look at number 6 on our trading checklist. Number 5 was what is the market direction, and we can clearly see it's uptrending. We want to look at the market direction in all time frames. I would place more importance on it on the major time frame and the intermediate. Of course, that's where you're basing your trading decision. You're basing it on the intermediate time frame. But number 6 is, are there any warning signs? And to me, although this seems like a almost perfect trading opportunity, there are several warning signs. We need to be aware that price could close below the support level and the trend line. And once we get a close below, that's almost like a confirmation. And this is what you learned in day 8 technical analysis. We spoke about just basic price structures in the market. We spoke about support and resistance, trend lines, ascending and descending channels, and we're really looking for a close below to confirm the move lower. Now in this situation, if we got a close below, that could be a warning sign. It could be a sign that price is going to continue to the downside. And if I just press play again, you'll see that that's exactly what happened. You can see price closed below this trend line. It failed to close below the first time. It created a higher low in the market. We got that reversal. We got out in profit, but then price reversed. It barely made a higher high. We can see that here. It's still a higher high in the market, but barely made a higher high. We would actually consider this possibly a double or triple top, probably a double top. And then price returns back down to the support trend line. We get a close below, which sends off a warning sign that price is going to continue lower. And I'm more than confident it retested this trend line, and then that's when it continued to the downside. And we'll find out in just a moment if it did or not. It might have just moved sideways for a certain period of time. Actually, if I just click exit, speed it up, and we can see that's exactly what happened. We did have a period where price moved sideways for quite some time, almost within this range between the D point and this resistance area here. This would have been the maximum, around about this area. See, price was moving within this zone, and not only did it close below the trend line, it closed below support. It failed to push lower. This is why it stayed within this zone. Then we got another close below, and then the overall trend just shifted completely, and now the market is downtrending. We can see previous to that, the market was in a solid uptrend. So we can see why the major time frame plays a big part in our trading. It can provide us with early warning signs on what's about to happen with the trading opportunity we're analyzing. If I just jump down to the 15-minute chart, this is the minor time frame. And I'll need to scale back a bit just so we can see what's going on. And this will be quite messy. What I'll need to do is remove a lot of the drawing tools we've been looking at. If I just make this slightly larger, this is the M-type structure we've been looking at. We're looking at the bullish back. This is a formation we want to go with. And this is really what I'm talking about with market confluence. We're looking for confluent areas in the market, where several working tools, several technical working tools converge within a close area. And within this one potential reversal zone, and this is for all time frames, of course, we're not just talking about the minor time frame here, we're talking about the overall trading opportunity. We had a solid support at the D point. We had the bullish back. We had a convergence of ratios, measured levels at the D point, which confirms the support. We had the support trend line. We also had a higher low in the market. It was in an uptrend, which was a good confirmation to place the trade, to go long. In that situation, you're continuing in the direction of the trend. So there's multiple technical working tools or multiple reasons to take the trade. Whereas if we looked at the Gartley, there wasn't as much going for it. There wasn't as much reason to take the trade. The price action going into the potential reversal zone wasn't confident with that. It was extremely bearish. So that is really what we're looking at when we're using market confluence. And like I mentioned before, it does provide a wider scope. when we're using this 4 times less and 4 times greater rule for our time frames. Now, this would have been the potential reversal zone. This is where the pattern completes. Remember, we're on the 15-minute chart. You can see we've got a nice range here at the bottom of the potential reversal zone. Ideally, we're looking to align it with the wicks, but what we don't want is putting it away down here. We want to draw in our trend lines or horizontal support and resistance where it makes sense, where we have areas of reaction. So we can see here that's exactly what we've got. Price pushes below the support, it gets rejected, forms a hammer candle, goes in the opposite direction, and that's really the reversal we're looking at. I'll talk about that in a moment. This is roughly where the Gartley would have completed, in this area here. So just highlight that. That's where the Gartley would have completed. We can see an extremely aggressive move to the downside. There's no indications of a reversal in that area. We can see price continues to push lower into this zone. It then creates what looks to be a flag formation. If I just copy and paste this, yep, that's exactly what it appears to be. We've got a flag formation after that impulsive move to the downside, and this is just multiple reasons why we would never have took Gartley. These are just all early warning signs. We can see extreme price action going into the potential reversal zone. There's no signal of a reversal, judging by the candlestick formations. The majority of these formations are all bearish, which tells me the sellers are totally in control at this moment in time. We then form a flag formation, which means we're looking for further downside. And this would have confirmed the D point for the bat. And I'm sure the bat pattern completed just below this wick here. It was around about this area here. That's the final ratio for the bat pattern. That would have confirmed the move. And look how precise that entry point would have been. And that's the kind of confirmation I'm talking about. When we went over day 5 with doji candlesticks and hammer candlesticks, we've got almost a hammer type formation here. You really don't want that upper wick to be much larger than what it is just now. But we've got a stalling candlestick. What I categorize them as is stalling candlesticks. Just to make it easier for you guys to understand what I'm talking about. So we've got these stalling candlesticks, dojis, hammers, shooting stars. We've got a hammer candlestick and a doji in this situation here. This would have confirmed the 886. And I'm assuming, if I had to go back onto the 1 hour chart, I'd be able to be more confident in this. I'm assuming this is the terminal price bar. That would have confirmed the last ratio in the potential reversal zone. So once that candlestick closes, we're then looking to enter the move. And that's a really good confirmation. When we're looking at that candlestick there, on the 15-minute chart, we've got a reversal candlestick followed by an indecision candlestick. We've got a doji. And then this is where the move started. And you can see we've got a move away from the potential reversal zone and straight into profit. Just really an excellent move overall. But I feel like it was a really good lesson to provide for you guys, just based on the two patterns and where you may go wrong in your own trading. And this really just comes with experience. There will be times where you draw up a formation and you go with the wrong one. And you know what? That's why we keep trading journals. We reflect on our trading positions so we can learn from those mistakes and push forward in our trading and really become successful long term. Now, the next trading opportunity I want to look at is Made Safe Bitcoin. We do have another trading opportunity for today in Market Confluence. I'm just going to take a short break and then I'll jump back onto TradingView and we'll resume today's module. Alright, now for our final formation today, we're looking at a bullish bat pattern on Made Safe Bitcoin, which is a cryptocurrency trading pair. We're on the 4 hour chart, and I'll try and keep this one as short as possible. I think the last trading opportunity, I ran over a little in that one. It was around about 30 minutes, so try and keep this one below 15. I'm still providing as much detail as possible. The first step is identifying, is there a harmonic pattern? So we always want to identify that M or W type structure. And the bat pattern we know forms at the 0.886. And remember, when you're drawing in these patterns, make sure to use your ebook. That's what it's there for. It's there to help. I don't expect you all to remember the ratios off by heart from day one. It will take some time to familiarize yourself with these Fibonacci ratios, but over time it will become natural through trading experience, and eventually the ebook, you won't need it. So just for now, you'll of course validate the pattern by using your ebook to confirm the ratios for each measured level. Once we have our M&W type structure drawn in using the XABCD pattern tool, we want to decide what pattern is it. And we know straight away we're looking at a bat pattern. And where does the pattern complete? In this area here. We want to draw in all of the ratios just to confirm the ratios in the potential reversal zone to see where the pattern completes. The last ratio we're looking to confirm in the area. And that's exactly what we'll do just now. I'll just measure the move very quickly. We're going from X to A. And like I showed you with the previous example, you want it to be as close to that 50% measurement as possible in the bat pattern. You don't want to exceed that by much. Really, the maximum we're looking at is 0.55. And we don't want to go any further than that level. The C point comes in at 0.707. That is the closest ratio. Which means we're looking at a very sound C point in this situation. It doesn't go above the 886. We've got three separate tests of that 0.707 measurement for the C point. The BC measurement, we're looking at around about a 2.0 ratio. That forms just below the 0.886. We have the minimum 1.618. Price confirms that, but I'd be looking for the 2.0. We can see that forms closer to the potential reversal zone, or to the XA measurement, I should say. It forms closer in the potential reversal zone. But we've got the minimum measurement. It's more of a complementary measure. But I would go with that 2.0 ratio. We can see price confirmed that 3 separate times. And the XA measurement for the bat pattern, we're looking at a 0.886. We can see price confirms both of those ratios, and then of course consolidates before we get the reversal away from the zone. And that's really what we're looking at here. So once you confirm the pattern, you confirm all of the measurements, and you can be confident that it's a valid trading opportunity. You then want to decide, are there further indications of reversal at the potential reversal zone? So we have this ratio confluence, or this ratio convergence, where we have multiple measurements forming within the same area. And that's what makes these harmonic trading opportunities so powerful. But do we have any other indications of a reversal? So if we just go into our major time frame, which is the daily for today, we can see this is where the pattern completes. It looks pretty small in the grand scheme of things when you're when you're on the daily chart. And this is really what I'm looking at here. Without confusing you, there is a lot that I could draw in here, but to keep it simple, this is really, without messing up my charts, this is really what I'm looking at. And I actually posted this in TradingView, called it Made Safe. It's a Made Safe trading opportunity at low buying levels. It was of course, bullish bat. This was around about, when I posted it was around about February 2018, I'm sure. And when I first posted the pattern. And the reason I was so confident about this buying opportunity was because this zone, this grey zone, this is the lowest area, or the lowest price this asset has reached. We can see since June 2017, so we're looking at about 190 days roughly. Significantly greater actually, we're looking at 275, but if we go down to the lowest point, we're looking at about 190, 184. The asset has declined by 90%, and this is perfectly normal in cryptocurrencies. It sounds insane. You'll see this in stocks as well. which really provides us with a really cheap level to buy this asset. Price can't push much lower, and unless it's no longer traded and it just goes to ground zero. But it's a really favorable asset. It's within the top 100 cryptocurrencies. I'm sure it's still in the top 75. I'm more than confident. It was in the top 50 during 2017. It was actually quite high in the ranks for cryptocurrencies. And MadeSafe, I've always liked MadeSafe, what they're doing. They're a solid company. They've been around for over a decade now. And this buying opportunity, it forms at a very low level. We can see this is the all-time low for the asset. The X point almost tests that area. We can see we have a retest of that support zone. We can see this area here, this area of support. We almost have a huge sell-off to the bottom here. We can see this wick, but the sellers couldn't push price any lower, and the buyers regained control. And I'll just highlight another zone that I'm looking at on this chart. And this trade is still live at the moment. It's been going on for several months now. This is the zone that I'm really looking for price to return to. You can see this is the next key resistance area. See, over time, and it's years apart. This was in June 2016. This was December 2016. This was around about August 2017. Price keeps returning to this zone. And this is really where I'm looking for price to head from now on. Keep uptrending and achieve this area here. My take profit targets are in between these two zones, are around about this area here. I'll more than likely extend them to this area, and that's where I'll close my position fully, to wait for price to consolidate and provide further movement. But that's just a basic overview of the daily chart when we're looking at cryptocurrencies. You can see we've been provided with an extremely low area to buy, an extremely cheap price. And this is where most investors are fearful. In these kind of areas, most people at this area, this is what we call depression lows, most people assume that the asset will never recover, that the price is too low to buy, and if they buy it, it will stay low and they'll just continue losing money. In fact, in most of the time, it's the complete opposite, and these are actually the best areas to buy. And this entirely depends on the asset you're trading. You can't just buy a heap of shit and and hope that it will recover. And there needs to be some solid reasoning for that to happen. But in most trading situations, when you're looking at stocks and cryptocurrencies, and especially now with cryptocurrencies because of the nature of the market, this is by far the best areas to be buying cryptos. When it reaches an all-time low, it corrects by 90%. And it will consolidate because investors are not confident in this area because price is so low. And then once the big players come back into the market and they start buying up all of the coins, then that's when price will start moving again. If we just drop down to the 1 hour chart, that'll be our minor time frame for today. And after this, we'll round it up. We've got rookie mistake number 11 to get onto, and then we'll wrap up today's module. Just remove all of this. Just need to find that potential reversal zone, which is this area here. So we can see we've got the M-type structure. This is the 1 hour chart. The 4 hour is the intermediate. And I did look at this before, and there wasn't a lot going on here until we got out of the potential reversal zone. What I've seen from the daily chart and the 4 hour chart, that would have been enough for me to enter the trade once price confirmed the potential reversal zone. Of course, as long as there wasn't any extreme price action going into that potential reversal zone, and we did get some kind of reversal confirmation, I would have been happy with that and I would have entered the position. You can see it's quite messy when we're looking at the lower time frames on cryptos just because of the price feeds. This looks like a symmetrical triangle or a pennant formation just before price confirms the D point. So we can see we've got this sort of pennant or symmetrical triangle formation. We got a close below. Got a lot of spiking action going on here with these wicks coming back into the formation. You can see price tries to push higher again, and then that's when we get the decline. And it was around about this area here that the pattern formed. And I'm more than confident. If I just zoom out and I'll draw it in quickly, just so I can be more precise with the measurements, just so we can correctly analyze the potential reversal zone. Going from low to high. I'll adjust that A point in just a moment, but it's at the correct price level. So that's where we got the 8.6. So D point confirmed there. That was more than likely the last measurement in the potential reversal zone. The XA retracement of 0.886 in the back pattern. We can see price confirmed that ratio, confirmed the potential reversal zone. You can see price didn't close too far below the 0.886 measurement. If it closed down here, probably wouldn't have been as much of a favourable situation. But we did get a slight period of consolidation after price confirmed this final ratio. This is the potential reversal zone. So after we confirmed this area, we got a slight period of consolidation, and then price just started moving sideways. And it done that for quite some time. And if I just extend this level, you can see this is the entry point. We had several opportunities to get into the move. We did have one large spike lower. This is probably the sellers trying to push price down to the all-time low for the asset and failed. And this is where the buyers regained control. And we can see we've just got an area of consolidation. Price just moved sideways. There's not much happening here. And this was over around about a period of 1 to 2 months, I'm sure. 1 month. So we're looking about 30 days until price done anything significant. And then this is when price started to uptrend. Formed almost a channel in this area here. And these trend lines they're not exactly parallel, but that's where I would have drawn it in. We can see it's expanding here towards the top. We've got a close below. We would then extend this support level for the entry. And we can see that price doesn't return back to that entry point. If I just extend this resistance level, and you can see what I mean by the price action being really choppy. Ideally, we don't want price closing above our trend lines when we're drawing them in. We want them to be as precise as possible, but we also want them to make sense. We want them to draw them in where they make sense, where price is reacting the most. This can provide us a view of where price will go next. There was only 2 tests of this lower support trend line. So we can see price was uptrending. This is where we got the move away from the potential reversal zone, the first significant move. Price increased by around about 43%, so almost 50%, based on the entry point, which would have been in this area here. The D point would have been around about this area here. So this price level, this horizontal line, you can see price breaks down. We're now in what could be a descending channel for a very short space of time. Then we get a break to the upside, and this resistance that we're looking at here, this then turns to support, and price returns to that several times, and then we get the significant move away from that support level, and that's when it starts uptrending, and it actually starts to become quite impulsive towards this move here. And I know this looks kind of messy. We can use just these basic technical working tools, these basic chart structures, just to analyze where price is going next and how to manage your position. There's several other ways to manage your position. We will, of course, go in greater detail on this at a later stage. for now, we're just laying the foundation. We're getting all of the basics correct. I want you guys to become confident in your own trading. And if I just measure the move from the entry point, let's say we entered here, current price is this area, so it's up 50%. 50% in one trading position, and it's around about 60% complete towards the final take profit target of the move. The highest price was almost a 70% move, 70% gain on invested capital, which is excellent. And just using these basic chart structures on the minor time frame, it can just give us an idea of where price will go next. That's really what I'm trying to illustrate here. As much as we're trying to confirm the potential reversal zone, we're looking for these reversal confirmations on the minor time frame. We can also manage our position as well, and we can be aware of any errors or warning signs, like this channel here that we had drawn in and price closed to the downside. We now know we need to monitor that, because then price could move back down towards our entry point. Of course, the major warning sign in this trading setup was really that we were buying at extremely low levels, and price could have dropped further if investors were not confident at all and nobody was buying. Well, not nobody, but there was a significant amount of sellers. Then price could have totally obliterated our pattern. It could have just failed completely, and price could have dropped to the lowest point. Now, I didn't see price dropping any further because Made Safe is a valuable asset. I do see a lot of potential in it, and therefore I was more than happy to buy in this area. This is about it for this pattern. I felt like I've give you a good enough overview for market confluence. I could go over 20 different examples, but this is something we'll go over in greater detail in the future. Also, when we got into live trading as well, this is something I can do on a weekly basis, and I can talk you guys through different trading setups and what I see happening on the charts. But for now, this is just more of an introduction to market confluence, to encourage you to include all of your technical working tools in one chart. So let's head back to finish off the rest of day 11. We're now looking at rookie mistake number 11. Moving on to our rookie mistake for today, rookie mistake number 11. And this one is analysis paralysis. You guys now know how to correctly analyze the market to find profitable trading opportunities. Not only have you learned about candlesticks, you've learned about understanding the market, trending, ranging and congested market types. You've learned about different technical working tools such as pennants, flags, wedges, support and resistance, channels. You then went on to learn about harmonic patterns, which are an advanced methodology. They are measured moves. We have combined all of those into one strategy. My message for you today is do not over-analyze. This is extremely important. Analysis paralysis typically happens to new traders, especially during their first 1 to 2 years. It happened to me a lot during my first year of trading. And what happens is many traders overanalyze a situation to the point that an action is never taken, in effect paralyzing the outcome. And that's why it's called analysis paralysis. You analyze a chart so much that you don't know whether you should buy or sell. And then, of course, maybe fear kicks in. You think, well, what if I lose money? And in effect, nothing ever happens. You never execute the trade, and you've simply just wasted your time. Now, I'm not saying that you should take every single trade, because that would be a bad idea as well. You only want to take the highest probability trading setups you can in order to make a substantial amount of profit. But I'm saying don't analyze many charts and then never execute on any of them. So only analyze what makes sense. I don't want to see you using 10 different indicators and five of them agree with what you're trading and then 5 of them don't, and then you start panicking because the other 5 don't agree with what price is doing, and then you start looking for different technical tools and you're drawing in maybe trend lines that aren't valid, or you're drawing in pennants or support and resistance zones that don't actually make sense. So what I'm saying is don't add something to the chart that shouldn't be there. Don't Don't draw something in where it doesn't make sense. Use Confluence to your advantage. As I've showed you in the previous topic, step-by-step market analysis, I went over Euro US dollar and I also went over Bitcoin US dollar. So two totally different assets on different time frames. And as soon as you see several alignments, you see maybe the D point aligning with a support trend line, for example. You see the D point aligning with a horizontal channel. The D point aligns with the bottom support level. Then be prepared to take the trade. Okay? All of the work you're putting in, you want it to pay off. You want it to pay off in the long run. You want to make a substantial amount of profit. You want to become a successful trader. Well, that only happens when you execute. So you need to execute on your analysis and you need to get into the habit of doing that. Trust me, this is something we'll do in later modules. We'll put in the correct steps in order to do that. But that is why I gave you what we call the trading checklist today, so you don't become overwhelmed in your analysis. We know that there's a simple 7-step process. Identify if there's a valid harmonic pattern. Then ask yourself, what pattern is it? Is it bullish or bearish? Is it a bat, a gartley, a butterfly, or a crab? Where does the pattern complete? Well, it completes at the D point at this price level. Are there further indications of a reversal at the potential reversal zone? Well, yes, actually it aligns with the support trend line on the daily chart. It aligns with the horizontal channel. And you can ask yourself, what is the current market structure? What is the current market direction? Is it trending on the intermediate time frame? Is it ranging on the minor time frame? Of course, you want to analyze the direction of the market in all 3 time frames. I know I didn't do it in the previous example, but that is what you want to do. You want to analyze the direction on all 3 time frames. I didn't really stress that too much in the previous example because I don't want to drag out the module too much. Then ask yourself, are there any warning signs? Well, in the example with Bitcoin US dollar, we experienced that the D point completed at 7,150, but the daily support trend line was around 6,000 or 5,900. Therefore, we expect price to drop down to that support trend line before continuing to move higher. So the reversal zone could actually have been lower than the D point, in which it was. Then number 7, do other technicals support the pattern? Is there anything else on the minor time frame, the intermediate or the major time frame that you may have missed? What backs up the price move? And that is simply what I want you guys to do. Don't overanalyze, follow these steps, and this is how you pick out these high probability trading setups. Now let's just wrap it up for today. What I want you to do is provide as much reasoning behind a price move as possible. Confluence is absolutely key. So harmonic trading is a very successful methodology, but if we can use all of our technical working tools to our ability, this is how we find these high probability setups. These setups where the potential for profit is far higher. Start utilizing 3 time frames to provide a clearer view of market direction. So you now know that the intermediate time frame is where you find your trading setup. The major time frame is for market direction, overall market direction, to see where your intermediate setup fits in the bigger picture. And your minor time frame is for managing the trade, executing the trade you're looking to enter and exit on your minor time frame. Again, just to reiterate that, minor, intermediate, and major. And this can be any time frames you choose. For us, typically as a swing trader, it's a 1 hour, 4 hour, and daily chart. As we experienced today, I actually used the 15-minute, the 1 hour, and the 4 hour. As a swing trader, you can use this as well. You will have more short-term opportunities when using the 15, 1 hour, and 4 hour. Whereas when you're using the 1 hour, the 4 hour, and daily, you'll typically be holding positions for 2 weeks, maybe 3 weeks. Whereas if you use the 15-minute, the 1 hour, and the 4 hour, we've seen with Euro US dollar, it closed out in profit within just over 5 days. Now your trading checklist, as I mentioned in the rookie mistake, is simply a guide for finding high probability trading setups. This will change as you advance as a trader, as mentioned previously. Once you complete the Harmonic Mastery course, once you advance as a trader and progress through your trading career, you will maybe add in parts of your own choice. You may change your trading checklist to what suits you. But for now, this is simply a guide for the 14-day course and beyond. This is simply to help you find those high probability setups to make of course, a substantial amount of profit. Now in our next module, which is day 12 risk management, we will be covering developing a risk-off approach, followed by the major impact of high-risk trading, then compound interest, and finally risk to reward ratio. So everything's piecing together now. Day 11, I hope everything made sense today. This is where we piece together all of our technical working tools that you've learned from day 5 to day 10. I hope you guys enjoyed today's module. It's been extremely in-depth, but I hope you learned a lot from it. If you have any questions at all, as always, you can email me at lewis@sixfigurecapital.com. I hope you guys have a great day, and I'll see you on the next video.